We are talking about business loans and lines of credit today, and we're continuing on the debt conversation that I've started over the past 2 weeks. And after you've looked at your business and you've tried whatever you can to try to avoid debt, and you've looked through everything and you've cut out expenses, bootstrapped where you could, you're now like, okay, Hannah, I really need some cash, and I know what I'm going to do with it. I have a plan, so I'm going to go talk to the bank. Hannah, what do I need to know? So that's what this video is about. I'm going to tell you what you need to know and the difference between loans and lines of credit. And we're also going to talk a little bit about interest rates, so stay tuned for that. So let's just say that you go to the bank and you have the option. We're going to use a $50,000 as our loan line of credit, just as we're talking. So I have two boxes back here. I don't know if you can see them very well, but I have 50K and 50K. So if you go in and you are getting a loan, what will that look like? What does that mean? So if a bank gives you a loan for $50,000 after you've applied for one, they don't just give you money, you have to go through an application process. You will receive the full $50,000, and that the expectation is that you will repay it on a very regular payment plan. So this is where you will repay a little bit of principal and a little bit of interest each time. So this is really similar to a mortgage. So a mortgage, you pay your mortgage payment every month, and that has a little bit of principal and a little bit of interest each time you pay that amount. So let's say for $50,000 or $50,000, you're going to be repaying. So if this line is filling up the $50,000 bucket that you have emptied, you're going to be repaying a little bit each time. So each month, you're going to slowly fill in this amount. And that can be over a term. So let's say it's 5 years or 7 years. A lot of business loans are 5 or 7 years. You'll just slowly repay that money over time. Now, a tip on business loans is that you really don't want to be holding on to them as long as the term is. So you might be considering, I'll just hold on to that loan for as long as I can. But what I really would like to encourage you to do is to pay it off when you have the cash and the cash flow to do so. So whenever you're going into a situation where you're talking to a bank about a loan, I'd like you to ask them the question is there any prepayment penalty? So what that would be is that if you went ahead and you say like 2 years into your loan, you decided that you wanted to pay it back. Maybe you had the cash and you had $35,000 still outstanding on your loan, and you had the $35,000 and you wanted to give it to the bank. They might be like, oh, well, we're going to charge you 10% of the rest of the loan or something ridiculous. I'm just making things up. We're going to basically give you a penalty for paying it all ahead of time. And the reason that they do that is the bank wants you to hold your loan for the full term, because that's how they make their money. They make their money on the interest. So you don't want to have those prepayment penalties, but I want you to even assess, even if there is a little bit of a penalty, I want you to assess, okay, if it's $100, it's way more worth it for me to pay the $100 penalty, pay back the whole loan, and then you're not paying that interest for 3 to 5 years, however long is left on the term of your loan. So ask about a prepayment penalty, and if it's really, really bad, consider a different bank, is basically what I'm telling you. So some will be, no problem. If you want to pay it off the first month after you get the money, that's fine with us. They get that money back. They can lend it to somebody else who will use the term for the full time. That's fine with them. So loans are to be repaid over time, but if you have the cash to repay them back, please do, because that will save you a lot of money in the long run. All right, and the difference between, so that's a loan. Let's talk about a line of credit. So a line of credit is this little box over here. So a line of credit is more like a bucket of money that you can take from when you want to. So that is, if you were approved for a line of credit, again, you have to go in and actually get approved for a line of credit. They don't just give you one. That never happens. You have to go through the process of application. You have to be approved. So a line of credit is a bucket of money that you can borrow from. And it does not have to be on the schedule the same way that the loan was. So the loan, you have a very standard, you get all the money up front and then you repay it over time. A line of credit is more like, hey, here's this bucket, take from it when you want, put it back when you want. So you might say, okay, I haven't used it in a year, but maybe now I need $10,000 to buy something. Maybe I'm onboarding a new employee and I really need that $10,000 so that I can give them what they need to get started. I'm just saying, maybe onboarding costs, okay? So $10,000, but you know that you're going to be able to repay that because that employee is actually going to be helping you increase your revenue and you're going to have more cash in the next couple months. I'm willing to take out that money because I know I'm going to be able to pay it back. So let's say another month has come along and then you go, oh, I haven't repaid that 10, but I actually need a little bit more to buy this piece of equipment that I need. So then you take out another 10. So now you're $20K drawn out on your line of credit. So you don't pay interest on your line of credit until you are taking out the money. So whenever the money is gone like this, so I currently have $20,000 out on my line of credit, this is when I'm accruing interest. When I say accruing, that's when you have to pay interest on the line of credit. So that's when you'll start getting bills from your bank saying, hey, $500 is due this month or $200 is due this month, depending on how much is pulled out and what your interest rate is. So at any point in time, you can come in and put that money back. So say everything's going in your business the way that you want it to, those employees are totally working out, everything's wonderful, and you've got tons of cash, you're going to repay that money, put it back in the bucket, and you'll be back at a full availability of $50,000 again. So that is the difference of a line of credit to a loan. So the line of credit can go in and out in big chunks, in small chunks, kind of as you need it. So it's sort of like a safety net, really, is kind of what it is, because if you're not using it, you're not being charged any interest. So I actually do like my clients to have a line of credit because I would rather you, if you're in a really tight situation with cash, I would much rather you pull from a line of credit and use it on a short-term basis than I would have you run up your credit cards. Because if you aren't paying on your credit cards for many, many months at a time, you're going to be paying very high interest rates on those credit cards. And I just want you to avoid that. So the cost of using this line of credit is usually, a third or a half of what you would be paying to use credit cards as your financing option. So just kind of on that note of interest rates, let's talk about what you should expect when you go into the bank for interest rates. So all banks will use this, and then I'm talking about real banks here, not just kind of these, watch out, don't walk into these like loans for less, I don't know, whatever those types of places might be who are trying to sell you loans. Basically, if they're going to give you money without any questions asked, be suspicious, because they're not going to care who they're giving money to, because they're going to get so much interest back from you because they're going to be charging such high costs that it's not going to be worth it for you, but it's totally worth it for them. They might be charging 100% interest rates. I don't know, but they do bad things. So if they're not asking you for any validation on what you're making or anything, be suspicious. Go into a reputable bank, please. All right, so interest rates. What you're going to be finding right now, and I've talked to a banker very recently to just check in on where interest rates are at for these type of things, is what they call prime plus X. So prime plus a percentage. Right now, prime is a base interest rate. And this is kind of determined by the banks, kind of what all the banks will use as their base interest rate. And it fluctuates up and down kind of depending on the economy, depending on inflation, depending on what the Federal Reserve says. All these things will affect prime rate, and prime rate goes up and down basically every day. So prime rate is always kind of fluttering around a certain number. And then banks will charge prime plus. So they might do prime plus 2%. So prime right now, I just looked it up, is about 4.5%. So the bank might charge 4.5 plus 2.1, let's just say. Or to make it very easy on my math, 2.5. So 4.5 plus 2.5, we're at 7%. 7% interest rate. So that would be pretty standard right now. You're probably going to be between 7 and 8% at most banks for a business loan or a business line of credit. It's a little bit higher than it has been in the past. It's because all of the prime rate has been going up, and lots of other things as well. So basically how to calculate this is that you take your, so let's say what this 7% is an annual number. So if the bank is loaning you $50,000, they're expecting to make from you, you're going to pay them 7% of $50,000 each year, or 7% of whatever's outstanding on the loan. So on the loan amount, you're going to be repaying a little bit every month. So that amount, the principal amount goes down. So you'll be paying a little bit less than 7% at the end of the year when you calculate it. No, you'll still be paying 7%, but I don't want to get into too much of the math. So basically, just to give you an expectation of what you will pay and what your interest will cost, is to take this 50% and then multiply it times 7%. So that is, and I might be losing you here on the screen, $3,500 a year. $3,500 a year to borrow $50K. Now, when you break that into a monthly number, that's just under $300 a month. And that's just interest. That's just something that's not going into building anything. That's just your cost of borrowing money. And then you have to think, is it worth it to me to borrow this amount of money for $300 a month? That's the question for you as a business owner. But I want you to look at that number and say, is this worth it to me? Okay? Because if you have cash sitting in the bank and you have enough to cover your operations and you have a little extra, it might not be worth it for you to borrow at $300 a month. So always keep that in mind. Before you sign the papers for the loans, keep that in mind. Is it worth it for you? All right. So that is kind of the overview of loans versus lines of credit, interest rates, prime plus. So when you go into the bank and you talk to them and you ask what's the interest rate, they're going to look up prime rate, and then they're going to go, oh, it's prime plus 2.4. So then they're going to go and look at the prime rate and give you a number. Okay? So if you have any questions, I hope that you do, put them in the comments to this video, and I will answer them in the comments, because if you're not live right now, you might be watching this later and have questions. So, and then if you don't feel comfortable putting them in the comments, always feel free to message me, because I'm happy to answer questions through Messenger. So, that is it. I hope you have a wonderful day, and sorry for my scribble. I don't have the best handwriting. That's okay. All right. Have a good day, everybody. Bye.